And I am delighted to welcome back Peter Johns, Portfolio Manager at the Westferry Fund, for his second appearance here on the Coffee Microcaps Fund Manager Interview Series. Peter, how are you?
Yeah, well, thanks, Mark. Thanks for having me on.
For anybody who may have missed your first interview with us, can you give us an overview of the Westferry Fund? If people also have maybe come across you in the media or elsewhere.
Sure. It's a bit of a different fund in that it's a single fund that we operate. We're not sort of trying to run a funds management business. It's a single fund with all of my own money in it, and I manage it and essentially invite others to invest alongside me. And so there's no set limits in terms of the type of things we invest in. We do have some investments in unlisted assets and some indeed in other microcap funds that are a bit off the beaten track. But the vast majority of our assets are in ASX listed and New Zealand listed stocks, and the vast majority of those tend towards being microcap stocks, simply because they're the stocks where my expertise lies and where there's the best opportunity for someone like myself to have an information advantage.
And you picked two microcap stocks for us to talk about today. And the first one we're going to talk about is Sequoia Financial Group. So just want to give us a bit of an overview of what they do and how they make their money.
Sure. So both of these are stocks that are in the Westferry portfolio. Sequoia is a financial services company with offices around Australia, but with significant presences in Melbourne and Sydney. They are a collection, I suppose, of a number of businesses that are centred around and support financial advisors and accountants. So they have over 800 financial advisors working under their AFSL, and those advisors are charged for that service. Now, there's a number of similar type of businesses. It's a reasonably commodity type business, of course, and there's not a massive amount of money to be made out of providing that service. But what the CEO, Garry, Crole, I think has done very well with Sequoia is build up an ecosystem of businesses around that, which accountants and advisors can either use themselves or channel their clients into. And so there's a number of other businesses, such as a broking service called Morrison, which is a significant player, especially in options markets. Morrison's is also a clearing service, which obviously does its own clearing, but also does clearing for other brokers. They have in-house legal teams that do a lot of the documentation around self-managed super funds and the setting up of companies. They moved into insurance broking and a number of these adjunct services, including most recently a boosting of their media business, which essentially provides detail and content around investment options, and therefore gives advisors and accountants sort of an off-the-shelf information package they can use.
And the main investment thesis or why you like Sequoia, is it, they're one of the kind of players who have emerged post Royal Commission as the kind of new age kind of broad spectrum financial services company, and advisors are recognizing the offering that Sequoia can give them in this kind of new paradigm post Royal Commission, and they're kind of seem to be one of the winners out of it, or one of the ones who've adapted the best to the new environment.
That's right. And in a big picture sense, there's a drastic fall in qualified financial advisors in Australia in recent times, mostly or at least partly to do with the Royal Commission, which increased the education and training requirements. And it's happened at exactly the same time that the requirements with an aging population and fairly up and down financial markets has led to an increase in demand for those types of services. So as a starting point, it's an interesting space in terms of supply and demand. Now, where Sequoia, I think, are a winner and position themselves to be a winner is in that they are agnostic in terms of products. So they don't try to, or in any way, really link themselves to a particular supplier of any product. So the advisors and accountants in that situation can give genuinely independent advice, and advice that's seen to be independent too, because they literally don't have their own products to sell. So customers are able to be confident that they're not going to essentially a salesperson who's trying to channel them into an in-house product.
And if we take the flip side of that coin for a second, risks you see with the business, as you say, they're not connected to a product provider, but you know, that still mightn't negate fully, you know, mis-selling and bad advice and, you know, other, you know, huge kind of class action lawsuits we've seen here, the UK, America over the years for, you know, when advice can go awry. Is that kind of the key risk, or is there other things to consider?
That is a key risk. I think a lot of those major cases in the past have been linked to a poorer quality of advisor, perhaps when there was less training requirements, and it's been linked to pressure or either clear or at least suggested pressure to channel people into certain products. There's always, even outside of that, the risk of a rogue advisor. So that is a concern. It's something I've spoken to the CEO, Garry Crole, about. He is very confident in his systems of monitoring their advisors. He's run the predecessor to Sequoia, Interprac, for many years prior to it being joining with these other companies and becoming Sequoia. And it does have a fairly long-standing record and reputation now of having avoided those problems. But yes, it's always an issue. The other risks really are more in relation to the growth thesis. Look, we see the stock as being very cheap even without much growth, but there is fairly hot competition to attract financial advisors. So it's a case of Sequoia having to balance a sort of race to the bottom in terms of fee cutting or to attract advisors versus wanting to maintain a level of growth. And they seem to have managed that so far. The number of advisors continues to rise, and their very clear forecasts for this year suggests that they've managed to maintain a decent level of growth. And finally, in terms of risks, is market risk. Look, their price at the moment seems to be indicating that the market's concerned that Morrison Securities, which is a big profit driver within the business, it will likely suffer from a pullback in securities trading due to a downturn in the market. Morrison's tends to be very different in terms of order size and in terms of the type of trades that they are involved with compared to sort of most retail brokers. And look, from the guidance given to the market and my conversations with the company, there's at least to this point no suggestion that pullback is happening yet. So the market, though, is concerned that it may happen in the future.
And then if we, you know, look out 6 to 12 months on Sequoia, what are kind of some of the key things you're looking out for? Is it, you know, that they can continue to attract advisors still into their network and, you know, kind of get their fair share, or is it more how all these kind of ecosystem businesses are, you know, kind of doing themselves and kind of contributing to the overall group?
That's right. I want to see, I mean, it is a company that has had a lot of smaller entities sort of bolted onto it. I want to see that those are integrating okay and are not sort of being bought and then not contributing. The advisor numbers is key. That's right. I want to see at least some slight growth in that. And the company has made it clear that they're not going to pay out massive dividends, that their intention is to retain earnings for growth, and therefore I do want to see some growth in earnings. So they've made it clear that the FY22 results should show an EBITDA around 13 million or maybe a bit higher, and then which translates on our numbers to about 8.5 to 9 million NPATA once you add back amortization. And so that starts us off on a 10 times earnings, plus they've got some spare cash on the balance sheet. But if they aren't paying out much of a dividend, I do want to see some of that being reinvested well. So we would be keen to see year on year growth in those numbers, both hopefully organically and certainly from any acquisitions.
Okay. And I'll just mention here quickly, we've actually had Garry Crole, the CEO of Sequoia, present at our Coffee Microcaps Morning Meeting twice before. And I will, in the description below here, link to Gary's interviews and presentations if anybody wants to go back and have a look at those. But moving on to our second one, and this is one that's very much off the market radar, unless you're like myself and Peter and probably deep in microcap land on a daily basis. Ashley Services Group. Peter, why don't you give us a bit of background in them and how they make their money?
Sure. There's something of a link, I suppose, between this and Sequoia, and that they're both managed by people that own significant parts of the business themselves, which is something that we're always looking at. In the case of Ashley Services, Ross Shrimpton, the CEO, owns a very large chunk of the business. It had something of a difficult history that it floated in 2014 at a time when Ross's business, which was mostly surrounding the industries of labour hire and recruitment, was sort of bundled up with a number of vocational training companies and floated. It initially did very well, but then like a number of vocational training companies ran into difficulty with some of the practices that have been involved in those businesses. The vocational training part of the business was ground down to almost nothing, and the share price went from close to $2 down to as low as around 15-20 cents at one stage. So at that stage, Ross wasn't involved. He sold off the business, and it was being run by another CEO. Ross came back into the business after all this, and has sort of been determined to get things back to their former glory. Over that period up until now, the vast majority of the business has again been the labour hire recruitment business. They've got strong positions in retail and construction, some in white collar, and they've recently just done an acquisition in the last couple of weeks for a company in Perth that specialises in placement of oil and gas workers. So over the time, they've expanded in terms of geography and industry, and they've done very well. That the business has grown strongly. It's benefited, I suspect, from a tight labour market in the last year or so, and that's seen a serious acceleration of earnings. And in addition to that, the training part of the business didn't quite die. It stayed in the background, and in recent years, in fact, in the lead up to COVID, it was just starting to get some real momentum, but then was that was stopped immediately by COVID. Its training, which covers around 30 or 40 different sort of courses across various industries, has again started to gain that momentum, and so that's a reasonably significant part of the business again now.
Yeah. So, main investment thesis on this one, is it kind of a turnaround in progress? Is that kind of the best description of it, or why you like it?
Yeah, it is. I think it started to be something we owned because it was, I think, forgotten and despised because of what had happened after the listing, and people hadn't realised the change in management and the change in approach, and it has always sort of been cheap. It's in our view still cheap, less perhaps than it was, But the thesis now is that they've really managed to get some momentum with their earnings. Their earnings were very choppy for a point because they just didn't quite have the scale. They've now reached a point where their earnings are more consistent due to scale. And our thesis also is centered around the fact that they have a very good history of making bolt-on acquisitions. So we see there's a really good path to growth there, even if general economic conditions flatten. And we also see that the training business as being one that is a sort of a hidden gem, and that will also show significant growth in the coming years.
And risks to the business. I mean, obviously these labor hire businesses exist because companies want to be able to flex and turn on and off their kind of labor component as and when they need to, or in a rising interest rate environment. A lot of talk of are we heading into another recession? I mean, you've got that kind of macro risk. Anything else you're concerned about, or is kind of on the negative side of the ledger potentially for Ashley?
Yeah, I mean, it is mainly around the macro risk. They've benefited probably from the current tight labour conditions. You would expect that to ease over time for various reasons. One, the resumption of increased immigration once the influence of COVID finally settles. Secondly, the potential for economic conditions to slow. And so that may affect the business, and certainly when you're analysing the figures for this business, you wouldn't want to just assume that the current numbers for the labour hire business are your starting point. There's, to a degree, some regulatory risk around both industries, and that both are managed or influenced by regulations, but the company's shown in the last 5 or 6 years that it's managed to deal with those very comfortably. So we're fine on that front. But yes, it's mostly a case of, I suppose, not getting too excited by the very sharp growth that we've seen in the last couple of years. There's no issue that's going to slow, but we see it as still very cheap, because there will remain some growth in that area, thanks to acquisitions, thanks to the very strong balance sheet, and also thanks to the training business, which is only now recovering from COVID.
And then again, if we take a 6 to 12 month view on this one, what are the things you're kind of keeping an eye out for? You mentioned the business they just bought in Perth, so obviously we want to see that getting integrated, contributing now as we push through FY23. Expecting another 1 or 2 bolt-on acquisitions, or is it more they need to focus on get this bedded down and keep the training business on its upward kind of curve now that COVID is hopefully behind us?
Yeah, I think there's scope for bolt-on acquisitions. The most recent one's not a particularly large one. They did a much more significant one about 12, 18 months ago, which has, after probably a difficult start in the first few months, thanks to COVID, really performed very well in the last 12 months. So coming back to whether they can do those bolt-on acquisitions, what we're looking for will be some things around the balance sheet. So the balance sheet's traditionally been very strong. It still is, but the very sudden growth over the last 6 to 12 months has meant some demand on working capital. Obviously, they pay their workers and then are reimbursed, so that there's, as they grow, and if they grow sharply, there's an increase in receivables. So that's seen them dip into a little bit of debt. What we'd hope to see as growth flattens out is that the working capital starts to release a little bit, and the balance sheet remains strong. And if it does, then there's definitely scope for more acquisitions, both in the labour hire market, but also in the education market, which I think now it has some momentum, can really take off again and be renewed under a better management.
Peter, we'll just wrap up for today. Thank you again for joining us. If anybody wants to get in touch with you or find out more about Westferry Fund, get a copy of the PDS or Financial Services Guide, what's the best way to get in touch?
Sure. Our website is westferry.com.au, which has a lot of information about the fund. We've also got our monthly reports there where we disclose our top 8 holdings each month, so you can get more of a feel for the type of company in which we invest. Or I'm very happy to discuss stocks with anyone, really. So you can email me at peter@westferry.com.au.
Okay. Peter, thanks very much, as I said, for joining us again, and yeah, we'll keep an eye out on both of those stocks now as we head into results season over the next 2 months.
Great, thanks, Mark.
Thanks, Peter.